So for silver to get over 50 is sort of a catch-up, really. It's not an absurd assumption. Our expectation remains that silver is highly likely before the end of this year, which is, say, a handful of months, take out its all-time nominal highs, $50, and end up in the 60, 70 range before it even pauses. Okay, not that that's the top, but just that. And if you think about it, like, you use the word nominal, I think. If you think about it in real dollar terms, I mean, good grief, if you factored in the growth in the money supply, degradation of the money unit, since 1980, when silver was at 50, or since 2011, when silver was at 50, very briefly both times, by the way, silver would probably have to be $200 right now just to be in equal to those highs. Okay, and don't be surprised if that's what ends up happening.
Silver is pressing against one of the most critical lines in its history, the $50 level. That threshold marked explosive peaks in both 1980 and 2011, and for more than a decade, the metal has been locked beneath it in a broad base formation. Now, technical signals indicate that the market is on the verge of breaking free. A decisive monthly close above $50 would do more than set a new milestone. It could launch silver into a structural revaluation. Chart work points toward $55 to $60 on the first leg higher, with multiple methodologies converging on the same conclusion. MichaelOliver, the veteran analyst behind Momentum Structural Analysis, says the move is not a question of if, but when. He notes that silver and the mining shares have already taken the lead, and he expects that trend to continue. In his view, political noise and diplomatic drama may rattle markets day to day, but they won't derail silver's long-term trajectory. His conviction is clear. Silver will not only test the $50 highs before year-end, but could punch straight into the $60 to $70 range before finding its next pause. The groundwork for this surge is already visible. Since late June, silver has powered through the $33 to $34 zone and advanced to the upper $39s, signaling the start of a revaluation after decades of underpricing. Even the latest pullback, driven by shorting in Asia and Europe, has found strong support around $37. If the market can reclaim $37.50, Oliver argues, the path higher is wide open. What this means is that silver is no longer drifting in the shadows of gold. It's preparing for a breakout of its own, one that could rewrite the narrative for precious metals in the years ahead. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think it's quite strong if you'll pause and look. Early in the year, both metals surged. Okay, January, February, March, April. Okay. And in fact, silver, I think, made a secondary high at $35 in March, if you recall. And since then, if you look at gold, like from April close to the present, May, June, July, now in August, okay, total sideways. You almost go back in history and never find an instance where gold goes to sleep, especially after a big advance. Well, what we tell people is, hey, gold doesn't top this way. Never. When it tops, it tops. You make a high, you drop sharply, and then you work your way on down. But during that time when gold was asleep, silver went up. Gold miners, silver miners went up sharply. In fact, since April, you go back and look. It's just an amazing wake up for what had been the sleepy end of the monetary metals sector, silver, gold, silver miners. So they're back into a technical leadership position versus gold. And ever since April, you can see it. Gold sideways, they go vertical. Okay. And I think that's going to continue, that outperformance by the silver and the gold and silver miners. So gold is still in the stall mode. I suspect it's going to come out of it very shortly. Maybe they're waiting on the talks today, the big Trump talks with the Europeans and all that stuff, which really doesn't matter in the long term anyway. But our expectation remains that silver is highly likely before the end of this year, which is, say, a handful of months, take out its all-time nominal highs, $50, and end up in the 60, 70 range before it even pauses. Okay, not that that's the top, but just that. And if you think about it, like, you use the word nominal, I think. If you think about it in real dollar terms, I mean, good grief, if you factored in the growth in the money supply, degradation of the money unit since 1980 when silver was at 50, or since 2011 when silver was at 50. Very briefly, both times, by the way. Silver would probably have to be $200 right now just to be in equal to those highs. Okay, and don't be surprised if that's what ends up happening. But right now, our expectation is from a trading perspective, not long term. We're going a lot higher. But between now and the end of the year, I think there will be a burst that's already begun, actually. If you look at late June, we were coming up through 33, 34. Now suddenly we got near 40 recently. No, excuse me, the upper 39s. I think getting up into that zone will be like a refreshing burst up out of the mire, of silver's vast underpricing for the last decades. I think this time around, it's different. I don't think we have a normal bull market in monetary metals here where you're going to go up to gold, $850 and then drop back to 200 like it did between 1980 and 2000. Go up to the $1,920 high in 2011 and drop down to 1,050, that kind of stuff. I think there's enough major macro, technical, and fundamental events underway globally, but also with focused in the U.S. because we're the greatest error out there right now in terms of the bubble, stock market bubble particularly, that when that breaks, and it will, and I think we're in the process of topping the S&P and the NASDAQ and breaking that bubble, that the consequence monetarily will be a global shift here, there, more there, countries adopting money that's backed by gold as opposed to fiat. I think that thought is already out there. The Chinese are already expressing it to other countries as well. And silver is, after all, I know everybody likes to think it's an industrial metal, but if you go back and look at its history, its major swings up and down, forget about this week or that week, okay? It moves with gold, doesn't move with industrial metals, okay? Sometimes the industrial metals like copper and so forth are in sync with silver, but don't let that confuse you. It really does not follow the commodity complex so much as it is in step with gold. So even silver could be monetized. And already we're seeing some state legislatures, I can't get into detail, but Florida, Texas, and there's a lot of others who've said not only they're not going to tax gold and silver transactions, it's just like money, buying something. They are legal tender. Whoa, what a statement. I mean, when a state government describes gold and defines gold and silver in their state as legal tender, in fact, I think in some of them you can pay your taxes in it.
MichaelOliver points out that over the past 25 years, gold has surged more than 11-fold, while the S&P 500 has gained just 3.5 times as much. For him, the lesson is clear. Gold's greatest strength isn't just long-term returns, but its role in preserving wealth during crises and systemic shocks. History illustrates the point. By 2007, a $100 investment in gold made in 1971 was worth about $2,200. Just 3 years later, in 2010, it had grown to $3,800, even as the S&P 500 investment declined nearly 10% during the financial crisis. Looking further ahead, by 2024, the same $100 in gold will have risen to roughly $7,000, while the S&P equivalent will stand at about $26,700. Both rewarded investors, but Oliver emphasizes that gold shines when markets break down. At the same time, he argues today's setup for monetary metals isn't a repeat of earlier boom and bust cycles. In the past, gold's rallies were sharp but short-lived, soaring to $850 in 1980 before collapsing to $200, or hitting $1,920 in 2011 before sliding to $1,050. This time, Oliver sees something different, a structural shift in the global financial system. With the U.S. stock market stretched into bubble territory and confidence in monetary authorities eroding, Oliver believes gold is entering a phase of lasting revaluation, not another fleeting rally. The signs are already visible. Just this week, gold climbed from $3,330 to $3,350 after political pressure on the Federal Reserve raised doubts about its independence. Let's get back to the interview.
But when we went into that stall from mid-2020 surge highs in the monetary metals, for several years, gold went lateral in a range between mostly 1700 to 2000, briefly got down to low 1600s. But silver and the gold and silver miners actually eroded. They went into like a staircase. And during that time, not only did sil go down versus the others, but it went down more. Therefore, its relative performance was weak. Just like silver relative to gold was weak. Okay. The recent reassertion by the miners, silver miners especially, and silver, has broken the technical of that erosive process when you plot it as a spread. And if you look at the silver miners even year to date, they're up more than the gold miners. So they're catching up. It's like a wet bar of soap because they're such a tiny little sector. Even the whole mining sector is gold, silver mining, but silver especially. That when money flows into that sector, it's like the wet bar of soap. Everybody's grabbing it, it just scoots. And so we've seen some very dramatic action. Now, even recently, price has almost always lagged to momentum, which when we plot our momentum charts, they'll usually break out well before the price chart does something similar. And if you look at a GDX chart or a SIL chart monthly, go back to the 2011 peak, put it up on your screen if you're watching this show, and you'll see that for SIL, there was a total rectangular range up, down for 10 years now. We're above it. We broke out above it last month and fully out above it this month. Same with GDX. If you then take the simple technical notion of a swing objective, measure the depth of that base, low to high, low to high, low to high, and add it to the base, you're going to be up at the 2011 highs just to satisfy that minimal technical swing based on price. I mean, after all, gold's above its 2011 high. Heck, even copper is above its 2011 high. So for silver to get over 50 is sort of a catch-up, really. It's not an absurd assumption. And for the miners to get back up and take out their 2011 high, it's way lagged to gold, but it's a catch-up. And in the process, it'll be rapid, I think. I don't think it's going to be arm wrestling all the way back up to the high. In fact, you've started to see that lately where it's more vertical than we've seen in a long time. So anyway, that's what price is now telling us. Even price chart is saying, hey, you better be long. I just broke out. And I think once you prick that stock market bubble, more and more of that blood flow will move into the gold and silver miners. And these people aren't going to go out and buy silver futures. You know, most people don't do that. In my experience, since I got into the future side of the business, I was a kid practically in the mid 1970s when gold was legalized. 75, I worked with Hutton, E.F. Hutton. I've seen a lot of little headlines that pop up here and there of some war incident. Somebody shoots somebody they didn't expect, army versus army. And so, suddenly anybody who buys those news headlines usually gets kicked in the gut for having done it. In other words, you might get a little spike in gold upside because of that, but it's ill-advised buying. If you shorted gold in the few weeks after that event, when it was near a high, you nailed it, and you made about we were up in the above 2,000 again in price. It dropped to 1620 by fall of 2022. You dropped 20% in gold after that war event started. So when the war started, commodities and gold both peaked within days or a few weeks of that event after having had a major move well prior to the event. So if you bought war news then, you got killed. Now, ultimately, gold reasserted itself. But I find war events are not the driver of gold. You want to know what the driver of gold is. Get an M2 chart or a money supply chart from any country, Western world. Put it on your screen. Do the math of every 10 years, what's the rate of growth in the money units, the supply of money, and therefore the degradation of money. When your granddad built a house, it cost him $4,500. Now it costs $450,000. So is that because houses are? No, it's a degradation of the money unit. Gold maintains its value versus the ongoing degradation in the money units, period. And until that ever ends and we go to a gold-backed money here, there, and globally, finally, that's going to continue. It holds its value. You go back like 25 years ago, summer, in mid-2000, gold's gone up more than 11-fold. S&P 500's gone up 3.5-fold, which has done better at preserving your money. Okay, it's the degradation of the money unit ongoing. Yes, there are times when gold will inhale and exhale and inhale and exhale, but ultimately the curve, it will maintain its value versus the degradation of the money unit. Not because of this war that, yeah, sometimes wars help stimulate money growth because they print money, but governments don't really need that excuse. I mean, you go back to the mid-50s, well after World War II, and you'll see this upward curve in the money supply, regardless of a war here or there. Okay. So anyway, that's my argument. If you're in gold, don't make that mistake that it is driven by uncertainty. No, it's driven by certainty. Certainty that the money units are constantly degrading. Period. Okay.
Silver's battle with the $50 barrier is more than a chart milestone. It's a test of whether decades of undervaluation are finally coming to an end. Technical markers, shifting sentiment, and the steady hand of long-term demand suggest the market is moving into a phase where hesitation gives way to acceleration. Gold, meanwhile, continues to reinforce its reputation as the ultimate store of resilience, proving its worth not just in gains but in protection during times of crisis. Both metals are signaling a structural shift that could redefine how value is measured in the years ahead. If both silver and gold are stepping into new chapters of revaluation, does this moment mark the beginning of a lasting reset in how investors view and hold tangible assets? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.